All right. Good morning. Good morning, everybody. Today is hurry up and wait. Hurry up and wait. We're very likely not going to see much before Friday's numbers. We had Fed speakers out yesterday chipping their teeth, and it seems like we have more today. Bullard and Bostic. It's unlikely that they're going to say something that wasn't already released yesterday, probably just reiterating the message. They're all going to sing from the same hymn book, so to speak. But one, they always have a chance to, put their foot in their mouth and screw up and say something inappropriate or out of line or something that wasn't supposed to be said. And two, they always have the capacity for an agenda. There is such a thing as the plunge protection team. And although we don't need it, it doesn't always have to be something that can stop the market from going down and make it rally. It can be the opposite. It can shut a market rally down and make it drop. So, they have that. They have that power. So if they come out with an agenda to move this market, they can certainly do that. We don't have any expectation that that's going to happen. Non-farm payrolls is going to be on Friday. So the job numbers that we're doing today, jobless claims, continued claims, looking at what the Fed whisperer guy, Nick Tamaros, or however you say his name, he came out with a tweet yesterday saying the number of job openings stood at 10.5 million on the last day of November, which was unchanged from October, which initially was set at 10.3 million. The Fed wants to see the ratio between vacancies to unemployment work decline. And right now that ratio is sitting at around 1.75%. So jobs are going to be really important. That's something that we really want to focus on this week. It's something we want to be prepared for, that we have the capacity due to the numbers that are coming out between today and tomorrow, but more tomorrow than today, to really see this market break the range that we've been in and finally start doing something. And at this point, I can tell you, I don't really care what it does. Let's go, right? Break this and head to the downside, or shore it up and let's go to the upside, but let's get the heck out of this box already. So potentially, maybe we could see that. Powell is also now set to speak on January 10. That won't be in America, though. It's going to be in Sweden. Unlikely that he's going to say something at that to, drop the markets. But if he has an agenda, that would be a place where he could, grind that axe. The FOMC minutes came out yesterday, and Nick, put in a little bit of his 2 cents. If you're not following this dude on Twitter, it's worth adding to your toolbox. When the Fed is in a blackout period and they can't come out and speak, they will leak things through this guy. And if they are out speaking and it seems like the media is not getting what they're putting down, this guy will clarify it for them, right? So he's a little bit of a mouthpiece, a little bit of a puppet, I guess. Doesn't mean that everything he puts out is from the Fed, but certainly worth keeping your eye on. So we've got Bostic and Bullard, and we have additional auctions today. We get the crude inventories today. Again, it's late. It's supposed to be on Wednesdays, right? But, because of the holidays and everything, we're getting it again on Thursday. and we're getting some of the job numbers that we've been looking for. But tomorrow's the big one. So that's why today is hurry up and wait. Amazon is laying off more than 18,000 employees. Now, CRM, Salesforce, laid off employees yesterday, and their stock popped nicely to the upside. It'll be interesting to see what happens with Amazon today. So far, it's up. We're getting more information on a China reopening. Remember, that was one of the two catalysts for an upside move. If they had dropped everything all at once, it very likely would have been a rocket ship to the upside. But they've been gradually reducing their COVID zero stance just a little bit at a time. And that has, allowed things to kind of creep up a little bit, or at least not dump. It is considered, or it's seen as inflationary for China to open back up again, something to keep your eye on too. And traders are still anticipating a rate cut by the end of 2023. They're still not getting the message, which is why we need to be cautious when the speakers today, Bostic and Bullard, and we need to be cautious on the 10th with Powell, because if they feel that the market still ain't putting things in perspective the way that they've clearly, bluntly stated more than once that they're not going to pivot, they're not going to cut in 2023. It's not happening. They've got a long ways to go. And when they finally do peak, wherever that peak happens to be, they're going to hold it there for a while. They've said it, and they've said it, and they've said it. So the market still hasn't got the message. Maybe they need a helmet and some crayons. They quit licking the window. We're starting to see a little bit of the Euro-Japan pair move up, kind of shaking things loose a little bit. It's worth keeping your eye on. I know it's not a pair that we talk about very often, but you got to shift your attentions when things kind of moving around a little bit. So Euro Japan, kind of keep your eye on it. The breadth over the last few days has been nonstop buying. And although we don't really see it, it is under the surface continuing to be this nonstop buying pressure. It's really interesting. JC Peretz from All-Star Charts, he came out with an article yesterday. It was a seasonality article pointing out, election cycles and how it interacts with the market, and, how everything out there is basically running from the lower left end of your chart to the upper right end of your chart, right? Everything's headed up except for mega market cap, all the sexy, glamorous names. They're the ones that are finally getting beat down. If you think about the bubbles that began popping in 2021, it was small caps, and then it was mid caps, and then it was large caps, and then it was mega market caps. Well, those small and medium cap companies have already bottomed, based, and have started running back in the other direction again. Most of the market, looks good. It's only those really big, sexy, glamorous mega market cap names that we all focus on, Apple, Microsoft, that are really struggling and or are just straight down, like Tesla. It was an interesting read. You can find him on Twitter, and the article that he had wrote, he published a link for it. You can find that. JC Perez, shouldn't be hard to find, or just search All-Star Charts. I have watched his material on stockcharts.com. That's how I know who he is. He hosts over there sometimes. So as you can see, we have a pretty full day today. If you're doing a 0 day today, the morning is probably not going to be a good time to do it, right? More than likely want to wait into the afternoon. The last auction that we have is at 11:30. So once we get past the noon window and we start getting into the afternoon session, you should be fine for an afternoon 0 day. But I would stress caution against doing a morning 0 day with all of this econ and with those different bed speakers out there today. Volume is light. This is implying that the job numbers we have coming out this morning are going to hold more weight than they normally do, right? We know that tomorrow's the big one, non-farm payrolls, but this is telling us that today may hold a little bit of impact, even though normally it's not as impactful as tomorrow. It's one of the reasons that we use this generic little volume tool down here on the bottom. It gives us a snapshot every morning at 7:30 where the cumulative volume is from the overnight hours and if it's been heavy or not. When it's below 100 and it's not a holiday or a shortened day or something like that, we have to really ask the question, what's up? Why is it so low? Typically, that's econ. All right, well, we know we got econ today. We just looked at it. There's a lot of it. It's not supposed to be a very impactful econ, but this says that it could be today. We have that capacity. So we want to be a little extra cautious as we come into that econ window. We're still inside day, not much of a surprise. This is the entirety of the range that we have to work with. So we're better than 50%, but we're nowhere near that high. 38.96, pretty close to 3,900. 3,900 is the previous week's high. So if we can get there and break above it, we would be in an inside week breakout, which we had on Monday in the Globex. Sunday night, Monday morning, we broke up through that zone and then dropped back down inside of it. Couldn't keep it. The ADR right now for a 21-day ADR is $77, and that is at 38.32, which is really close to 38.36. That's the low of yesterday. Now, what I like to do when we're inside day, and right now we're IX10 because we're multiple inside days, is break this day down into different quadrants or zones. If you start with the low of yesterday and the low of our own Globex today, that would be zone 1. From the low of the Globex this morning to where we opened last night in the Globex, that would be zone 2. From that Globex open to our own Globex high, that would be zone 3. And then from our Globex high to the high of yesterday would be number 4. So 4 different quadrants or zones that you can focus on. Each one is a little bit of a milestone or a benchmark move. And inside of each one of them, you could focus on their internal pivots or just look left logic. Another way to do it, if you're not too interested in the zones, is still to play the same standard, what I call institutional pivots, open, high, low, close. Right. So the open of last night, the high of yesterday, the high of the Globex, the low of the Globex, the low of yesterday, those 6 pivots would offer you, milestones and goalposts to focus on as well. The good thing is you can't get it wrong, right? And the better trade, if you're not interested in sitting at the computer all day long trying to scalp out random reversals, would be to just focus on the edges. When we get up to, the Globex high again, or when we revisit the Globex low, like we had this morning, or like we had late last night, revisiting the edges. Of course, that requires patience, and who has time for that? You can see the volatility that they're pricing in for tomorrow. It really stands out. We got an 18% vol today and a 19% vol for Monday. But for Friday, we've got a 25.5 vol. So it really stands out that tomorrow is anticipated to be impactful. Even if you didn't know why tomorrow was going to be impactful, just seeing that really large number there would help you identify that something was going on, even if you didn't know what that something was. That's why it's useful to come out and look at what's going on in the options chain, even if you don't trade options. Support, resistance, momentum, trend, inertia, surprise, economic events, it's all in here. You can see it. It may feel a little bit like you're looking at the matrix, but it's in there. We've still got our classic D shape, but we're losing it a little bit. It's becoming more distorted. We've got a volume structure around 3,900. And we've got a minor one starting around 38.10, 39.10, and 38.10. Two numbers to keep your eye on. I wouldn't expect those to be support and resistance necessarily. I wouldn't lean on them and expect them to stop price or to hold the market, but they make great first touch plays, and they are a magnet or a focus. If we start getting close to them, we're very likely going to go there because that's where the liquidity is at. Otherwise, we're still struggling with the point of control, 38.59, 38.60 area. The 5-day, 5-minute volume profile, I like to call this mapping out the 5x5. We don't have any point of controls to carry forward, and I'm not really interested in bringing in the value area high and low, since I'm already focused on open, high, low, close, and they would just be so close together that it would just be more clutter and more lines, and who needs it, right? So if you were to study volume profile, however, that's what they would tell you, is carry those lines forward from the previous day. I'm not really interested in that. But what I was looking for is to see if there was an untouched point of control, what we call a VPOC. We don't have one. If we were carrying forward yesterday's point of control, you could see that we've already passed through that zone twice. And so it's no longer an untouched point of control. We do have one underneath us at 37.88. And I believe if we scroll far enough upwards, we have one above 4,000. Unlikely that we're going to see either one of those today. We haven't gone anywhere this week, so looking at how far away from the 10 we are, it's not much of a surprise that we're still where we were earlier in the week. We're in the center of the basketball court. We have the capacity and the ability right now to make a move in either direction of more than 3% away from the 10. Up or down, and it wouldn't be considered overbought or oversold at that point. So we're wound up, ready to go. Just like with yesterday, I would still measure out a 3% move. And the reason why, let's just get rid of all this here for a minute. The longer we stay sideways, the more likely it is that we're going to make a big move. It's kind of like nature itself. You can't contain something in nature without releasing some energy. That's why they let water out at the spillway. If you just contain nature and hold it back without releasing it, it'll build up and build up and build up until it explodes. But right now, the market is winding up, building up more and more and more and more and more. It needs a release. It needs to pop. Now, when the range was a little smaller, those releases come when we overshoot a high or we overshoot the low, we wick through a zone and we come back in again. Those are little releases of pressure. And we haven't had that. So from December 22nd onward, and I'm on a daily chart, we've been holding inside of this range. Now, when the range is really big, holding inside of it doesn't really matter because it's a really big range. There's plenty of movement for price to wander around and not be contained. But when the ranges start to get smaller and smaller, and then we're still maintaining inside of that, that's when things have the capacity to really start building pressure. So we're going to move this box a little bit and focus on these last 3 candles. So on the 3rd, on Monday, we set that big red candle. Tuesday, we were completely inside of it. We didn't wick out of it. We didn't wick through it. And now today, we're completely inside of Tuesday. The range is getting smaller. The highs are less. The lows are less. If we go through today, still sitting inside of yesterday's price without wicking through on either end, then we'll be going into Friday really wound up, full of pressure, ready to make a move. There's an indicator that was built on this that kind of measures energy. It's called the RSI Laguerre, which is based on an old school indicator called the choppiness index. And Doc Severson wrote a book on it, and he really focused on the word energy, which is weird because, well, in most indicators, we don't use that word, right? We use things like inertia, trend, momentum, strength. We don't use the word energy very much. And yet, I mean, that was like the key theme in the book that he really focused on, that indicator. The idea is we learned a lot when that indicator came out. We learned a lot about how a market can gain energy. And then when it makes a move, we can see if that move is made with energy behind it. Markets sometimes make a move to gain energy. So at that point, when we see a market making a move, we're able to answer a question. Is it moving to get energy, or is it moving while burning energy? And the analogy difference would be, if I throw a ball to my son, I put energy behind it and I threw that ball. And the ball is going to lose momentum and it's going to lose speed as it loses energy. And if he doesn't catch it, it's going to hit the ground because it just ran out of juice. Take a ball and throw it off the top of a building, and the more it falls, the more energy it picks up. So sometimes something is moving with energy behind it, and sometimes something is moving to get more energy. And that indicator can kind of highlight for us which one of those two it is. Well, one of the things we learned with that indicator is that when prices ranged like this, the longer it ranges, the more energy it builds up. Now, it doesn't promise direction, just energy. We're still looking for the directional break. And since we're range bound, what we do with a range is measure the candle. 100% of that measured move that I just did right here would be 40-50. That would be 100% of the move. And that would put us back to the top of this range up here. We can do the same thing the other way around. And that gets us down to 36.57. So there's your plus or minus. It doesn't necessarily have to come from the job numbers tomorrow, but at some point, we're going to finally eventually break this range. And it's very likely that it's going to be a range break with a really large candle, something that looks like that candle there, or maybe that candle there, right? Something like a Marbozu, or just this really large expansion bar. $36.57, $40.51. Now, the cool thing is, if you go over to, say, the SPX is such a large product that has so many options that you can go that far out of the money and still find options. And the options value rate of change in the SPX is really impressive. You go that far out of the money and spend 5 pennies, literally $5. Can't even get coffee at McDonald's for $5 anymore. Buy some calls for 5 or 10 cents. Buy some puts for 5 or 10 cents. Hell, buy them both. It's not like we know which direction we're going to go. The market makes a big move. One side or the other is going to pay you. The funny thing is I did this before the FOMC that we had, the December FOMC. Bought both sides. Both sides paid because we had a big move before FOMC with the CPI move to the upside. So my calls paid off. Then we dumped that big move, dropped right back down, and my puts paid off. So ended up getting both sides covered. Now, there's no guarantee that you're going to get even one side covered if you buy this far out of the money on each end. You could lose on both sides, but you can also win on both sides because we move that far in a bear market, right? Bear market, we move a lot. It's violence, it's volatility. So give it some consideration. Yesterday afternoon, I spent the afternoon working the order, and I bought, a couple of options on the SPX. Most of them were for today, Jan 5. Working the order 5 cents. It took most of the day, most of the afternoon to get those 5-cent trades to fill. But I didn't want to pay up because these are low probability trades. And the way that the options market works is the lower your chance of winning, the more likely it is that the payout would be big if you do win, right? And of course, the lower your chances of winning, the lower your dollar value is on the loss, at least if you work the order. It's an inverse correlation, right? If you're in a high probability trade and you lose, it's going to hurt. That's the way options work. But if you're in a low probability trade and you lose, the loss is really small because you were taking a chance on a trade that had basically a chance in hell of winning. So try a couple options prices, spend the afternoon working the order. Don't just pay up. I was running some back tests on options Omega yesterday afternoon as well to see historically would this work. And it works great in a bear market, but if we were in a bull market, it wouldn't, because we just don't move enough for those really far out of the money, like a 2 or 3 delta option to pay you, right? We need big moves. And in a bear market, well, that works because we get big moves in a bear market. So for your strike selection, there's no science behind this. Look at the cost of the option itself. You can see this 34.80 is between 5 and 10 cents. Well, it's not going to get any better than that, but I don't have to be that far away because all of these are 5 to 10 cents. So I can come all the way up to at least 3,600. Then we start getting into 5 cent to 15 cent. We'll split the mid on that. It's still 10 cents. So now I can get even closer still. On some of these, like that 36.50, we were just talking about 36.50. I'd like to get that put, but I don't want to pay up. Set that order for 5 cents, come back in and bump that order through the day and see if you get filled. One of my orders filled at 3.58 yesterday, right before market close. There was just enough volatilities pushing in prices around that I got a 5 cent option filled. Now, this is the very definition of a lottery ticket, right? This is not a great strategy. It's not something you'd want to do on a day-to-day basis. But we can see econ coming. We can see that we're in a compressed IX10 state. This market has been compressed for nearly a month. We're ready for a big move. If you were to do a straddle or a strangle, it would be expensive. But if you leg into these, working the order for 5 cents, what's going to happen if you're wrong? You're going to lose 5 cents. I think you can handle it. Do the same thing for the call side. Just work the order. Try to get it as cheap as you can. I put on some spreads as well using the January 20 expiration. So kind of close, but not too close. And kind of built them around the structured levels that we've been talking about. On the put side, I used 3,600 and 3,580. And on the call side, I used 4,100 and 4020. Basically, I put a call debit spread way up there. And I put on a put debit spread down here. Now, those are debits, not credit. It's a really bad idea to put a credit spread on that far out of the money, knowing that violence or volatility is coming. Because you're only going to collect like $1 and you're going to risk $1,900. And it can very easily just run you over and keep on going. It ain't worth risking $1,900 to make $100. It's a bad idea. But flip it over. I bought it. I didn't sell it. I spent $1 for a chance to make $1,900. I'm willing to do that. All right. So just, some ideas to think about with this looming big move on the docket. And, by the way, and I don't say it enough, it doesn't owe us a big move. We could get the numbers and they could be right in line with analyst expectations and the market doesn't do anything. And we just still stick into this range going into Monday. That very well could happen. So it doesn't have to make a big move. It's when we catch them off sides that we generally make that big move, though, right? When we surprise them or get a number that doesn't match analyst estimates. Not getting a lot of love here on the China ADR names. It's kind of a mixed bag, more negative than positive, especially for the big names, BABA, JD, PDD. So China names not looking really hot this morning. The Asian markets closed up reasonably. I mean, not spectacular, but at least they were positive. XLE doing relatively well this morning, along with all of the ancillary energy names or energy spaces that would go with it. Oil and gas, exploration, just straight up energy. oil services, all of those doing, reasonably well this morning. On the other side of things, though, natural gas still taking a beat down. KWEB, which is our ETF for China Internet, China tech names. Financials, which is a really big deal. This has been the one saving thing this whole week, the financials. It's like they're running the banks up before earnings, right? And banks kick off earnings season and usually set the tone for the quarter, right? If banks get their face stomped, the rest of the quarter usually turns out pretty bad for all the other names too. We've seen the banks getting bid up. It's very likely that they're running them up into earnings, but the banks are down this morning. I like to use KRE for regional banks rather than just the XLF, but XLF is fine. It's just more of a broad brush, right? And it has a lot of names in it besides banks. It's got insurance and credit cards and trading firms and lending institutions of various sorts. So it's just a bit too broad. KRE does a better job, but you wouldn't want to trade KRE, right? If you were looking to trade financials, you're better off trading the XLF, way more liquid. All right, so this kind of illustrates the move we've seen in the last few days. Consider where we closed. So we closed here, and we ended up closing here, and then we ended up closing here. It's not too bad if you think back to December 28th as the start of this move. So we closed on December 28th, went into the 29th, and then the 30th. So we went from 33.80 to over 35. And for a very small ETF like this, that's a good size move. It's a 3% move in a week. I like trading the XLF because it's really, really cheap options. As small accounts need to focus on small names, and yet it has liquidity. It's got a reasonably decent bid-ask spread if I wasn't so close to the front. I mean, it's not SPY when it comes to liquidity, and certainly it's not SPY when it comes to the bid-ask, but it's not that bad. We got a market maker move on the XLF this morning too, by the way. So these are down this morning. Down to flat. We've still got a significant gap to close at around 36. It's a long ways off. If this move starts to falter here, we're going to head back towards that quarterly level of $34. All right, so JP Morgan's down this morning, but the other two that go with it, Bank of America and Wells Fargo, not down by much. Usually these three will run together in a group. So if one is doing something that the other two aren't, the other two usually play catch up. Citi and Goldman and Morgan Stanley is not necessarily an image of liquidity. Tend to not day trade those. They're liquid enough for swings, but not so great on the day trade stuff. But with these three down on the bottom, Citi's already made the move. Goldman Sachs and Morgan Stanley have not. They're kind of still stuck in that basing pattern down here. So could be looking for these two to reciprocate and join their cousin or sister or whatever you want to call it. You can see the range that Citi was in before it came out of that range with that top side breakout. So we're just looking for these two to complete the cup the same way that Citi has already completed the cup. And if we continue to see that kind of move in these, we should continue to see that move kind of follow through in the financials back up to that 36, that quarterly level that I was talking about. Apple had some news yesterday. They reached out to some of their suppliers and had talked about not making as many widgets or parts for the iPad and the iPhone. They actually used the word lack of demand. Finally. All right, so there's that bump on Amazon from the news that they were going to cut 18,000 employees. Doesn't seem like it's going to stick. We've talked about this before, and it doesn't work the same way in equities as it does in the indexes, but we've set a pre-market high. Watch for that to get tested before a dump, right? So we're going to be looking to see if Amazon comes in at the open and makes a run up, gets above 87, see if it can get into that 87.5 for a head bump before rolling over and dumping back down. It's unlikely that this little bit of a pop that we got is going to stick. Remember, CRM had the same thing yesterday, and they didn't keep it. But we didn't get that run up in CRM yesterday either, right? When it set that high, when we got into the open, we never went back up and tested it. But that bump in CRM yesterday is exactly the same thing. They put out a statement that they were going to cut some of their workforce. The market liked that, popped to the upside, couldn't keep it. Now we got the same thing in Amazon. Still going to have to focus on, can it keep it? Netflix continues to prove Seeking Alpha right. I believe it was Seeking Alpha. So this is on the contrarian list for 2023. Everybody's mostly bared up on the FANG names, the glamour sexy names. Everybody's bearish on those. That's why this is a counter trend for 2023. They're bullish Netflix. At least that was the takeaway from the Seeking Alpha watch list, or the list of contrarian plays for 2023. This is one of the two that I liked that was on the list, Netflix, and the other one was Meta. There's nothing that would make us think that it's going to, make these runs back up and recover even half of what it lost, right? But that's the whole idea of being the contrarian, is kind of going against the system, against the trend, against the move, and trying to make a play for the other side. Like Tom Sosnaff always says, if you don't like my trade, take the other side. Well, if you don't want to join the crowd that thinks Facebook's going to continue to go down from here, take the other side. But they've continued to hold up and press nicely to the upside. And I think an argument could be made, much like we were talking about with SPX, of getting some far out of the money option with much more time, right? Maybe a good 100, 120 something days out. Me, I like to do things in a spread just so I don't have to put, $4,000 or $5,000 on the line for a maybe. That doesn't make me feel too good. I don't like maybe. Maybe's not a really good strategy. But you can see these are $500, $700, $900 options. Look at Netflix 450 strike, which is around 162 days out. Liquidity, the bid ask is a little wide. Putting $800 on the line for a maybe. Nah, we have no momentum. We have no trend. We have no pattern or signal or setup that says go long. It's not a good reason to put $800 on the line. But turn that into a spread. What are you risking? $50? Okay, I mean, I don't even like risking 50, but I'm more comfortable with 50 than I am with 800. If you do buy the call, just straight up buy the call, at least you can defend this. Right? You can buy this, and if we don't go up, you can sell calls in front of it. Just come in here and, slowly but surely, you can sell some calls in the front and make your money back. That's fine. But if you're more of a set it and forget it kind of person, focus on buying the spread. You can even continue to run it farther out of the money until you find a price that you like. Here's $30. Now at this point, I'm out 500 and the current market is sitting at around 300. So we're $200 away. The expected move says we can move $100. That's a 1 standard deviation move. So for an outlier, if we were to move more than that, we could see these pay out nicely. But remember, we don't have to get all the way to 500 for these to make money. We only have to start moving in that direction at a relatively fast clip. and this spread would start to make money that way too. That would be something worth thinking about in a lot of these names that are beat down. Just remember, there's no signal that says we should be going long. All right, you can see that breakout move in the dollar and the reciprocation across the board, US dollar China, US dollar Japan. We're not really seeing much out of it in the S&P and the NASDAQ yet. The VIX. It looked like today we were going to get below that $22 mark, and yet that seems to be holding for the moment. Well, it looks like the numbers were a significant miss from the forecast. The actual number is 235, forecast was for 150. There it goes. Maybe the nerds just had to talk it over for a minute. All right, so it wasn't as big and explosive as it could have been, but tomorrow still holds the attention of everybody, right? It's a more important data point than today. So while this is moving around slightly this morning, it could pick up speed later on as the gravity or the brevity of the data really starts to sink in. But it's more likely that we're going to kind of kick our feet up and wait for tomorrow. Still got our levels marked. They'll be just as good tomorrow as they are today, unless we leave this range today. Then we'll have to rebuild everything tomorrow. We had an evening star reversal on the weekly in USO and a nice follow through. We're a little bit up this morning, but we've still got that massive gap. We want to see this continue to maintain underneath 65.50-ish. And right now in the pre-market, we're up 65.25. So we're kind of close. But you can see that squeeze. These are the Bollinger Bands. No, those don't look like Bollingers. Let's take it out to another chart because those could be Celts. Not much of a squeeze. But it's just a little bit of a bid up, and this line graph shows it perfectly. We had a good solid run to the downside. Now we're getting a base, a little bit of a bid up, bounced on support, rally into resistance before rolling over. I don't think we're ready yet for the rally in energy. It's not necessarily what the rotation is looking for. Here's crude oil. It's that same move. Now the move in the dollar, that's what's getting the attention right now. That 105 level is the kind of the line in the sand that we need to get through. If we're looking for a serious shift in market dynamics, the dollar has to get above that 105. We've continued to threaten that 103, kind of a 103 half, 104 area. And as long as we held above that, the market wasn't really going to do much for a rally. And now we're getting this run up. We got to really think about getting above 105, or we're not going to really see this market sell off either, right? We're not going to break through those structures that we were looking at in the S&P. So if the dollar stays in this range-bound state, we're very likely going to see the rest of the market stay in a range-bound state. With the move that we're seeing this morning, it's a good start. You see bonds are selling off. That kind of goes against conventional wisdom too. Is the understanding that bonds had started to come back up after this sell-off here. So we had the nice run up, a pullback. It looked like we were starting the next leg. And here we are in the pre-market, down 0.5%. So we got stocks and bonds both moving to the downside. And we've got the dollar and US dollar Japan making an aggressive move to the upside. Euro Japan, nice expansion upwards too. I think we're going to get a little bit of fireworks today after all, if these don't start finding some support. Watch US dollar Canada for a proxy on energy, by the way, XLE, and then crude CL or USO, especially with USO today having the petroleum status report at 10:30. All right, your FANG names are taking that gut punch. Apple's still slightly positive. Amazon is because of the news, and then Comcast. But even Comcast looks like it's giving it back. Walgreens had earnings, didn't work out too good for Walgreens. And American Express had a dividend, and it's down 2% this morning. So that one's kind of bucking the system since the rest of the financials were looking better. So still a muddy picture, right? It's been like this now for a couple weeks that we don't have anything really solid to focus on. We're still sitting on our heels waiting for the range to break, either through econ or, market structure, and we still don't have it. Keep your eye on the prize. Patience wins out. Everybody be safe. Keep your eye on those currency pairs, and I'll see you all tomorrow.